I also notice that nominally at least, the prices of gold and silver mining companies measured against the price of the commodities is the cheapest it's been in 50 years. If you believe, as I do, that the gold price is going to go up, at least nominally in US dollar terms, it stands to reason that the mining companies could and probably should outperform the metal. You need to be willing to do some work. You need to be able to take operational risk to make the transition from being a bullion investor to an equities investor.
In this insightful snippet, Rick Rule lays out a compelling case for why the price of gold could soar in the near future. Over the past 23 years, gold has demonstrated resilience, delivering over an 8% compounded return, outperforming many other investment avenues. Rule highlights concerns surrounding quantitative easing and ballooning government debt, factors that erode confidence in fiat currencies and drive demand for gold as a safe haven asset. With on-balance sheet liabilities in the US exceeding $34 trillion and off-balance sheet liabilities surpassing $120 trillion, negative real interest rates further exacerbate the situation, diminishing the purchasing power of savings. Rule emphasizes that gold isn't just a speculative investment, it's a hedge against economic uncertainty. As he notes, the nominal price of gold and silver mining companies relative to the commodities they produce is currently the cheapest it's been in 50 years, suggesting significant upside potential. For investors seeking to safeguard their wealth, gold represents a prudent allocation in a diversified portfolio. Like, share, and subscribe for more invaluable insights into the world of finance and investing, and don't forget to turn on post notifications to stay updated on our latest content.
First instance, why gold? Gold, simply put, is catastrophe insurance. It is what people buy when they're afraid of the maintenance of their purchasing power in savings and investment products that are denominated in fiat currencies. It has been thus for 1,000 years, and it is so today. When will gold move? Well, my answer to that is I began enlarging my bullion holdings again in 1998. And in terms of when will gold move, 23 years ago. The price of gold then was $253 US an ounce. It's 2,000 now. So over the last 23 years, gold is up a little over 8% compounded. In other words, it has stood the test of time relative to inflation. Try to find very many equity indexes, never mind bond investments, that have generated 8% compound rates of return for 23 years. I happen to believe that the gold price is going to rise faster in the future, but I don't need that to justify my narrative. Why might it be so? Well, historically, gold has done well when people are concerned about the maintenance power of their savings, particularly in the world's reserve currency, the US dollar. And why might people be concerned about that? Well, for one, quantitative easing, the tendency that the United States has to create new currency units out of thin air, unbacked by anything. Whether or not you think that's good political policy, making a whole bunch of something does not enhance the value of the existing supply of that thing. By the way, if you were to go print Benz, your own quantitative easing, you would be called a counterfeiter and you would be put in jail.
Unless it
But
was
if
a
you were
Ben
a
coin.
congressman or a member of parliament, it would be highly popular public policy and you would be reelected. Irrespective of that, it doesn't increase one's faith in the store of value of existing currencies. But it gets much worse, of course. From a US perspective, and I'm sure from an Australian perspective too, debt and deficits at the federal government level are terrifying to anybody who can do arithmetic. In the US, I don't know your numbers, but in the US, our on-balance sheet obligations exceed $34 trillion. Now, your readers' eyes will glaze over because they don't know what a trillion is. Suffice to say, it's a lot. But of course, it gets worse. The off-balance sheet liabilities, not represented by bonds, but rather promises to pay, entitlements, Social Security, Medicare, Medicaid, old guys like me, military pensions. That number is estimated by the U.S. Congressional Budget Office to exceed $120 trillion. So at the federal level in the United States, the on-balance sheet liabilities, off-balance sheet liabilities exceed $150 trillion. And we propose to service that with a budget that's in deficit $2 trillion a year. In other words, we're not servicing it, we're adding to it.
Mm.
And that number came about at interest rates that are half the interest rates that exist today. Truly ugly. But the thing that should make you most afraid of savings assets denominated in the US, and I suspect the Australian dollar, is negative real interest rates. Your listeners, I think, have been conditioned by the ABC and by American networks to believe that the CPI, the Consumer Price Index, is a measure of purchasing power. But it's not. It's an artificial construct. First of all, it's hedonistically adjusted, which means that the guys who create the index assign values, non-market values, to things like technology and housing. Secondly, when it's inconvenient, it doesn't include food or fuel. I happen to like to eat. So that's problematic for me. But the worst thing is it doesn't include tax, the largest component of living expense that most Australian and American families face. So a cost of living index that doesn't include tax is farcical. My own belief, and this is anecdotal, is that in terms of the basket of goods and services that I purchase, I'm hesitant to call tax a service, but we'll leave that aside, that the purchasing power of my savings is declining at about 7% compounded annually. So if I put my money in a US 10-year treasury at 4%, in a currency where my purchasing power is declining at 7%, what is happening is I'm losing 3% a year compounded for 10 years. The government promises me that this is true. The first promise in my life that I believe that they will in fact keep, but not a promise that makes me feel very comfortable with maintaining savings and investment assets denominated in US dollars. So I believe I have to own gold. I also notice that nominally at least, the prices of gold and silver mining companies measured against the price of the commodities is the cheapest it's been in 50 years. If you believe, as I do, that the gold price is going to go up, at least nominally in US dollar terms, it stands to reason that the mining companies could and probably should outperform the metal. You need to be willing to do some work. You need to be able to take operational risk to make the transition from being a bullion investor to an equities investor. Mercifully for me, I enjoy doing it. It's a pleasure. It's not work. But I think that lays out the case very well. When audiences say to me, when they talk about near-term price movements in gold, my eyes glaze over. I couldn't care less. I don't own it because I think it might move from 2,000 US to some technical breakout level at 2275 or some hocus pocus like that. I own gold because I'm afraid it's going to go to $8,000 or $9,000. I remember in the decade of the 1970s, the stuff went in US dollar terms from $35 an ounce to $850 an ounce. Now, admittedly, that was from a price controlled level. But in 2000 to 2010, no price controls. Price of gold moved from about 250 to about 1,800. So it isn't a 10% move that interests me or a 15% move that interests me. To me, that's background noise. It's trading, flotsam and jetsam. I own gold because I'm afraid it's going to go to $8,000 or $10,000.
In this captivating discussion, Rick Rule provides invaluable insights into the enduring significance of gold as a safeguard against economic uncertainty. Highlighting its historical role as catastrophe insurance, Rule underscores the enduring appeal of gold as a hedge against the erosion of purchasing power in fiat currencies. With compelling data showing gold's resilience over the past 23 years, Outperforming many other investment avenues, Rule makes a compelling case for its potential to rise even further in the future. He points to concerns such as quantitative easing, ballooning government debt, and negative real interest rates as key drivers for gold's future ascent. As the nominal prices of gold and silver mining companies relative to commodities reach their lowest levels in 50 years, Rule suggests significant upside potential for investors willing to take on operational risk. So, whether it's the fear of gold reaching $8,000 or $10,000 that motivates you, one thing's for certain: gold remains an indispensable asset in any well-diversified portfolio. Don't forget to subscribe, like, and share your thoughts in the comments below.